With 20% of single-family residences owned by institutional investors such as BlackRock, financial institutions are taking this opportunity to raise capital and reduce risk. Credit risk transfers and credit-linked notes are used by the big banks such as JP Morgan and CREport to accomplish just that. But now, a regional Texas bank has decided to play with the big dogs. Is the market going to expand into a new phase with more and more regional banks seizing at the opportunity? Let's take a look at what's going on.
Soup's on.
Soup's on. Soup's on.
A credit risk transfer packages different tranches or groups of loans into one securitized package. Some of the loans, including the highest credit quality or the highest rated tranches of loans, will still receive a GSE guarantee, while other lower credit quality or lower rated loans are non-guaranteed. At the time of the credit risk transfer, the total unpaid balance of the loans in the tranche is written down. As prepayments are received on the loans, for example, when a borrower sells the home, paying off the mortgage early or refinances, the unpaid balance of the highest quality tranche that is guaranteed by GSEs are satisfied first. So credit risk transfers were pioneered in 2013 to take some of the risk off public entities and move it into the private sector. Now, as of September 2020, Freddie Mac has created $1.7 trillion in credit risk transfers, with $64 billion of mortgage risk transferred. These securities are purchased in the private market by money managers, hedge funds, real estate investment trusts, reinsurers, and insurance carriers, as well as other banks and financial institutions. There are a number of different credit risk transfer structures provided by the GSEs that focus on providing the right risk exposure for the end buyer. One of these structures, the one which Texas Capital Bank used for this deal, is the credit-linked note. Texas Capital Bank recently sold $270 million of securities, referencing $2.2 billion of loan exposure. Now, a credit-linked note is a security with an embedded credit default swap, permitting the issuer to shift specific credit risk to credit investors. Credit-linked notes are created through a special purpose vehicle, which is a trust, and it's collateralized with AAA rated securities. Investors buy credit-linked notes from a trust that pays a fixed or floating rate, which is known as a coupon, during the life of the note. In return for accepting exposure to specified credit risks, investors who buy credit-linked notes typically earn a higher rate of return compared to other bonds. So as of July 22nd, the average yield for mortgage-backed securities was only 1.36%, according to an ICE Bank of America index, and that was down from 2.4% in February of 2020. Now, the credit-linked notes, in the riskiest version, investors could reap more than 5%, and that trounces the 1.89% yield of the 30-year Treasury bonds, and it eclipses the 4% for corporate bonds. Hey, thanks for watching. I hope I was able to break it down for you. I'd appreciate it if you like, share, and subscribe, or leave a comment down below. New episodes are posted Mondays through Thursdays, with the exception of holidays. May be blessed and have a wonderful day.